Our next guest is one of the more famous bulls in the market. Tom Lee is the senior U.S. equity strategist for JPMorgan, going to be staying with us through the opening bell. Tom's year-end estimate for the S&P is a relatively high 1430, and his sector picks this year include financials, materials, and industrials. Tom, great to have you with us.
Glad to be here.
Fairly cyclical theme, Tom, huh?
That's right. Yeah, I think in some ways, if you're kind of lining up world events, it feels a little bit like 2009. I think that we're kind of in a post-financial crisis period, this time being Europe. And it's really driven by the LTRO's effectiveness. And then I think we're layering in a U.S. cyclical recovery that might pick up momentum from a housing recovery. And so if you look at historical episodes, it really argues that you want to be cyclically tilted this year.
What do you think about that Bloomberg poll we just showed? About half the people that we surveyed think that the best returns are going to be in the stock markets. Does that sound about right to you?
Yeah, I would just suspect if you did this survey at the same time at the beginning of last year, there were more bulls on equity markets. It's hard to argue with the idea that, when you look at relative value, stocks are a pretty good deal right now.
And U.S. stocks in particular.
That's right, U.S. equities, because you're getting pretty good global exposure. You're getting really well-run companies. You're getting companies that have very little leverage exposure. I think U.S. stocks make a lot of sense.
Well, if you look at the overall thing, Betty, one of the things that we talk about all the time is this idea that the stocks that we've looked at have come a long way. They've gotten back every bit of the loss that they had during the financial crisis. So the question is, even with valuations here, aren't we due for some kind of a pause here, some kind of a correction perhaps?
Yes. Actually, I think that there's a pretty good argument that, after a 20% rally over 4 months, the market has to digest a lot, or you'd have to have a real pickup in news flow or incremental flow to argue for another catalyst. Okay. That's right.
But earnings, though, I want to get through the earnings season. Today's a very busy day, but bank earnings, came through. And,
yes.
One of your sector picks is financials. Did anything change for you when you looked at the bank earnings?
Well, first of all, I think one of the sort of things we can observe that's interesting is, this hasn't been a great earnings season for financials. Only about 40% have beat, yet financial stocks have rallied. Well, that's pretty unusual. I think you haven't really seen.
What do you think is behind that?
Well, one, I think it's a pattern you haven't seen since really 2009. I think it tells us a lot about investor position. People just aren't long financials right now. But also, I think people are more optimistic about the earnings power over the next couple of years. Because, as Europe stabilizes, we're seeing sovereign spreads come in. That's a good opportunity. If we see housing pick up, that's good for bank demand. So it's good for financials.
Well, we haven't seen the bulk of earnings season yet. We've only had a handful of these companies report so far. What are you looking for later on as we head towards the heart of earnings season? Are there companies specifically that may change your opinion, or are there sectors in general?
I think the themes that are starting to come out, and I think I've been hearing from our analysts, is, there isn't a lot of visibility. There's companies that might have had some visibility in December, and maybe even some redacting some of that guidance. And so we're going to be very dependent on how the macro data starts to unfold. And, one of the good things is that the ISMs, these are pretty decent leading indicators. The European PMIs have been pretty decent. Mm-hmm. We got that yesterday. And then the U.S. ISMs, I think, are promising. So I think there's an idea that earnings beats will start to strengthen throughout 2012.
Moving from earnings to what's going on in Europe, I just want to play for you something that one of our market guests yesterday said about Greece, and I want to get your opinion on that.
Okay.
I think uncatastrophic. I think there would be a bad, short, sharp reaction by the market, and then we'd all get on with it. There's going to be a deep loss suffered by the private holders of Greek debt, whether you have a deal or a default.
So he says whatever happens with Greece is going to be uncatastrophic here in the U.S. You agree?
That's what I'm hopeful of, is that it's not catastrophic in the U.S. I think one of the things that
But you still reserve that fear?
It's just, I think that the tail risks are being diminished, and I think that's what we feel more confident of. That compared to December to today, the risk of a financial crisis globally has diminished. But you can't rule out a tail event.
You got to watch Apple. It's surging, obviously, in the pre-market on the heels of their earnings announcement. But I'm also watching, maybe no shocker here for some viewers, ExxonMobil as well. Why? Because with this move, if Apple does get what it got in the pre-market, it will surpass ExxonMobil yet again as the world's biggest company.
Tom, what do you make about the Apple result? What do they tell you?
I think it's a testament to why U.S. companies are blue chips. This is a company that's changed consumer culture, it's a global phenomenon, and look at the pricing power. I mean, it's a fantastic margin they have. So, I mean,
so you see it as a story for the entire market then? Or do you see it as just an Apple story?
Well, I mean, it's kind of a little bit of both, right? I mean, in some ways, it's such a big weight in the index. It actually is a market story. The supply chain effect is so big, and I think the effect it has on consumers is big. I mean, this, it's a pretty important company.
Okay. Well, no doubt about that. Brian, let me get to you. Brian Battle, the Director of Performance Trust Capital Partners over at the CME. And Brian, there's a lot of earnings to watch this morning, but tonight, or excuse me, later today, the Fed is going to be releasing their statement. And, what's going to be interesting in these interest rate predictions, I mean, how market moving could this be?
Yeah, the bond market has endured a little bit of a sell-off here, maybe 10, 20 basis points over the past couple of months, given it looks like we might not get quantitative easing as soon as we thought because the economy looks like it's doing okay. Earnings are coming out average. The economic numbers are coming in better. But today this is an absolutely historic day. The Federal Reserve is releasing the minutes, and then Bernanke is going to have his press conference. But more than that, all the details of their predictions, how long they're going to hold rates low, and maybe when they're going to start raising rates. This is new territory. And Betty, I sent you a quote. Greenspan said, if you think you understood what I said, you're mistaken. The Fed has always been obtuse, and this is a brand new era. It'll mean a lot for the bond market and foreign exchange, especially given what the minutes might release. So that might be a short-term move, but it might be very volatile given what they say and what the market interprets it as.
Well, Brian makes a great point here because the Fed has always been trying to become more transparent. There's an argument here to be made that the Fed is maybe becoming too transparent with trying to put forecasts out like they are going to do here. How does that change a strategist's view of how things are going to play out in the markets? Are you going to be paying that much closer attention to the statement just because they're going to make these forecasts?
Well, I mean, it raises a lot of interesting points about, what kind of language you're going to sort of focus on, right? Because, like, for instance, the mid-2013, how are you going to sort of treat that now that they have projections quarterly out to much longer periods? I still think you're going to end up having people forecast what the Fed's going to do, but now it's going to be centered around their projections instead of around their changes in language. Yeah.
So with that mystery, I guess you could call it, still surrounding the Fed, I mean, it's still going to be a very significant part of the markets.
That's right. Yeah, because as we know, the central banks play an important role of an economy and the business cycle. So I don't think that's going to change just because they're offering projections.
Right, Brian. Just quickly, I mean, what else are you going to be watching for today's session?
Yeah, the Fed. We had a couple of headlines. The State of the Union address. President Obama did say something about mortgage refi. Mortgage collateral is a little cheaper today because the devil's going to be the details. He promised a refi for everybody that was current, so the market really isn't absorbing that yet. And of course, we've been trading on headlines for the past couple of months, and there have been a dearth of headlines out of Europe. We're waiting to see what the haircut's going to be in Greece. That'll directly affect us. So I think that's going to be the next surprise in the market: how big the haircut is and who's going to have to take it.
What about for you, Tom? What are you watching for the next few weeks here?
I mean, I think we're watching earnings. Earnings is going to be important. I think we're going to look at some of the data related to housing, and then I think in terms of just the global economy, we do really want to get the sense that this cyclical economy is picking up. So progress in Europe on the PMIs and really the health of their economy, and then obviously with China. So I mean, there's a lot to watch. It's a busy year.
Oh yeah, no, absolutely.
Lots of fun.
Okay,
Yeah.
Tom, great to have you with us.
Thanks for
Thank you
having
so
me.
much. I really appreciate it. Tom Lee of JPMorgan, and also to Brian Battle down at the CME. And